Hi, this is Roger Nussbaum. Welcome to The Big Picture for the week of October 22nd. This is actually take two. My wife came home and there was absolute pandemonium with the dogs and it totally interrupted the first take. Anyway, we're going to go over three things this week. A quick recap of the market, talk about a prediction, a kind of a wacky prediction I heard about the S&P 500 on the Kudlow show, which you probably heard also, and then also talk a little bit about some of the newer narrower ETFs that are coming out from VanEck, and there's a couple coming from PowerShares as well. First, recap of the market. Kind of a dull week in a way, at least for the S&P 500. It was up just a couple of 3 points or so. Pretty flat week. One thing I touched on last week, I said this wasn't a prediction I was making, just kind of a if this happens type of statement. I said that if energy starts to do a little better in basic materials, if they both start to do a little better, then some of my lag from the third quarter, I lagged by about shade under 3% in the third quarter, I might make some of that back, and that was the case this week. We'll see if that trend continues or not. Energy, as you probably know, the price of oil looks like it closed below $57 for the first time, and the stocks really aren't going down as much as they were. I think maybe the stocks have sort of gotten used to the fact that oil may be cheaper than $78 for a while, and they've kind of built a base, and excluding some sort of shock from here that sends it down yet another 20%, which I think would be pretty unlikely. Assuming that there is no shock like that, I think maybe there'll be a little less volatility with the oil names, and maybe they can start to build back up. Probably if that happens, though, it would be much slower than the ride down of the last couple of months. Well, we'll see if that happens anyway. You probably heard on Kudlow a guy named Michael Crofton, who works for Philadelphia Trust something or other, made a prediction about the S&P 500 of 1750. He didn't give a timeline. Big shock, Larry didn't let him finish his sentence, so we don't know what sort of timeline he was thinking when he said 1750. But from here, it's about 300 points, so it's a tad over 20%, I guess, maybe, 22% or whatever. From here, that's a pretty big move. I would be really surprised if that happened anytime soon. I'd be pleased if it did, despite being a little underinvested. From here, if energy doesn't cascade lower and if materials don't cascade lower, I'm going to capture most of a big move up. I think I'll lag it a little bit, but not by as much as I did in the third quarter. So I'd be pleased with that, although I don't think it can happen. We've seen so much time go by without a 10% correction, and from the standpoint of this is how the market works, we're drifting way out of that fat tail. Hey, how about there's a topical word, way out of that fat tail of how the market normally works. Certainly it could happen, and I'll go along for the ride if it does, but I'm not going to commit new money. At this point, I think I'd be chasing, and not what I need to do, I don't think. If the market goes up 20% from here and I go up 18, I'd be doing cartwheels over that. That is a huge move up, regardless of the lag. Lastly, let's talk a little bit about some of the newer ETFs. They kind of offer a double effect, if you will. That they have their primary effect of whatever, steel or the environment or clean fuel or yada yada, but they also offer a secondary effect. This is one of the things I talked about with the water ETF, as it is with the Market Vectors Environmental Services ETF. Secondary effect is industrials. If you look at what's in there, most of the names are industrial. The cap size is a little smaller than just about any other industrial sector ETF you're going to find, and that's because General Electric has a colossal weighting in just about all of them. Sure, there's a couple where it doesn't, but who can keep track anymore? The point is, though, that in addition to the primary effect, they do offer other diversification benefits to a portfolio, and that's fairly important. I don't think we're at a point in the cycle now where trying to get smaller in cap size makes a lot of sense. Humor me here for a second, pretend I'm right about that for the time being. When the cycle does start to turn up, both the economic goes through its recession and then back up, and the stock market goes through its bear market, if that's going to happen like they usually do and starts to turn up, then at that point some of these ETFs that offer smaller access to some of these broader sectors probably at that point would be a good bet to outperform. I suppose they could do it now, who knows, but you've got sort of history and market mechanics on your side by, for now, just watching them and then adding them when the cycle looks like it's going to start to turn up. I think we're going to see more and more of that as these ETFs that come out, or the ETF companies rather, try to chase narrower and more unique products. I just turned in an article for TheStreet.com about a couple of the mining ETFs. Similar thing. They both add volatility. They both add a little smaller feel, just a little smaller, to the broad-based materials ETFs. May not be a great time to add them now relative to where we are in the cycle, but again, pretending I'm right for just a second, I can guarantee at some point there is a time that you do want to add volatility, and by putting these on your monitor now and watching them, you'll be able to make a more informed decision when the time comes that adding volatility is the right thing to do. Hopefully I'm saying that in a way that makes sense. If it doesn't, you can just leave a comment. And that's it. Have a good weekend.